Welcome, welcome, welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn from Focus Compounding, on air live with Mr. Geoff Gannon. Geoff, how's it going today?
It's going very well, Andrew. How's it going with you?
It's going great. We hope it's going great with everybody else as well. If this is the first time you're tuning in with us, thank you so much for joining us. Be sure to check out all of our content that we put out there on the internet. Go to focuscompounding.com to get access to free investment write-ups from Geoff, going all the way back to 2005. If you're interested in learning more about our money management services, reach out to me at andrew@focuscompounding.com. If you hit that Invest With Us tab on our website, you'll learn everything that you need to learn about us. What is Focus Compounding? Well, let me tell you, we are a long-only equity-focused hedge fund located in Dallas, Texas. We are focused on identifying high-quality companies in an overlooked pocket of the market, hence our strategy focusing on overlooked stocks. We do have a managed accounts arm, and we do have a hedge fund arm for individuals that do not meet certain qualifications for the hedge fund. What we're looking for an overlooked stock, a business that's predictable, a great industry or solid industry. Then, of course, the price that we're willing to pay needs to be in our framework. So, won't bore you with the details if you listen to us every single week. You pretty much know our framework and the types of businesses we're looking for. But if you don't, you could go to the Invest With Us tab and pull all of this information. And of course, read just thousands and thousands and thousands and hundreds of thousands of words from Geoff on his investing framework and how he thinks about businesses. Our investment minimum for the fund is $2 million, no management fee, and we charge 15% of the profits with a high watermark. And then managed accounts, it's a $250,000 investment minimum with a 2.5% management fee, 0% incentive fee, no high watermark. And we custody those assets at Interactive Brokers. We are registered with the state of Texas, so be sure to check out the disclaimers in the About section on this YouTube video, if that's where you're watching it, or in the description on the podcast app. And of course, that disclaimer is also on our website. Read our disclaimers. This is not investment advice. We are just two guys that love investing talking about it on the podcast. So where we sit currently today, the market, Geoff, November 9th, 2022, I feel like I could just repaste the exact slide deck from, the past 2 months, but the S&P 500 is down 21% year to date. 10-year yield currently sits at 4.151%. Crude oil, $85.59, and natural gas still hovering around $6, currently at $5.93. Geoff, have you been following everything that's going on in crypto land and in the markets the past few days?
No, I'm somewhat aware of them.
Okay. So funny. I was talking to a buddy and I was saying, hey, do you have any topics that you recommend for us to go around the show? And he brought that up and he said, but also I feel like Geoff will probably say, I've read a few headlines, I'm aware of it, but I don't know much about it. And I figured that's exactly what would be your answer on that, which is good. It shows that you do not focus on all the craziness that goes on every single day in the markets. Long story short, there's a lot of information coming out about FTX and its collapse. And it's going to be interesting to follow over the next, few days to few weeks. Doesn't it seem like the tide, is this what Buffett talks about when he says, when the tide goes out, you really see who's swimming naked, Geoff? It seems like every single week now, there's just some huge major blow up that's happening in the markets.
Yeah, this is what he's talking about.
So more on that. And I guess to continue on from our conversation about Meta last week, they had announced that they are laying off more than 11,000 employees, which I believe is somewhat 10 to 13% of their workforce. Stripe is laying off 14% of their workforce. Salesforce, Redfin. It seems like the list goes on and on currently in the tech world. And I'm just kind of curious to hear your thoughts on how will these layoffs affect the job market, the talent market, salary expenses for companies, especially when so much of this year has been, talking about like wage inflation. I'm just kind of curious to hear your thoughts on how this typically works its way through the system.
I'm not sure it will affect it much. This is something we thought about before that, or talked about a little bit before, that I don't think that people, for instance, with college degrees, computer programmers, take jobs that are the kinds of jobs that we have a really tight labor force in. And so I think that you can sometimes have like an overqualified workforce. That's a problem. You get into this distinction where you can't move between different kinds of labor that you need. I think that's become more of an issue over time. So we, a while back, I mean, it might have been a year or so ago, we talked about it, and I said, like, I think that it would be, the economy that you're in, if you, don't have a high school diploma or whatever, male don't have a high school diploma, more rural place, whatever, that you're going to do better relatively than you're used to. And if you're have a college degree working tech things in, San Francisco and stuff, you're going to do worse than in the past. And that's just because of the supply of those different sorts of labor versus what we needed. And this kind of labor was oversupplied.
So do you think a lot of this will be insulated to the tech industry and like Silicon Valley in general?
Yeah.
I mean, it seems like this is much like 2001 tech crash.
Correct. Yes. I think that that's the issue. We talked about I mentioned incestuousness and all that between companies, but same thing with the labor. I think that it's somewhat insular. So I don't know that it would, you might have high levels of unemployment, slack in these sorts of companies at the same time that you have like no unemployment for people in oil field services or something. I don't think that one's going to affect the other much. And I think that you get deceived by that when you look at the overall levels of things. I mean, we talked about that with the unemployment rate, where we say, unemployment rate's 3.5% or whatever. That's the average across everything. That means that it's way lower than that in some industries and some areas of the country. And it means it's higher than that in others. But that's why you can't run an unemployment rate so close to being way too low, because it means in some parts of the country, some industries, it's impossibly low, right? Because half of the things probably are above the average that you're seeing and half are below.
Uh-huh. Well, I guess we'll just have to wait and see how it is as it works its way through the system. I mean, there's been a lot of talks this year, obviously, of the inverted yield curve and where we currently stand. I'm kind of curious. I mean, how are you thinking about financial stocks where we currently sit right here? I mean, is this going to be one of the most challenging environments for bank stocks in particular, where we currently sit with the yield curve inversion?
It depends on what kind of thing that they're doing. For a bank like Frost or something, it's not a problem. But for banks that do a lot of mortgage stuff, it's a problem. So it depends on how long it lasts and if it looks like other times that this kind of thing has happened. Obviously, we talked about 3-month, 10-year. That's inverted, and historically, that's pretty much perfect predictor of a recession. It's a question of whether it's a recession a few months after it inverts or a year and a half after it inverts, but it's pretty much perfect indicator historically.
Why do you think it is perfect? I mean, like if you think about it, like logically, what it means. I mean, is it really just because everything just starts to slow down and, ultimately sort of the second and third order effects of these major slowdowns, like in real estate, in lending, in money tightening, those are just typically the things that precede a recession. Why do you think it's a perfect indicator?
Well, so from like a theoretical perspective, there should be a rate of time preference in terms of people should not be willing to lend at 0%, and so you would expect that's sort of something that we've that's kind of the idea that we've talked about before, is like that's theoretically true. But you've had things where you've had central banks in some parts of the world that have kept things at negative rates and all that. That's obviously government policy that's driving that. Same sort of idea here. We take the same sort of idea in terms of how theoretical this is, but I can't really think historically why anyone without government intervention, without central bank intervention, would want to accept a lower rate for something that has 10 years till maturity versus something that has 3 months. So why would they do that? They would do that because they expect future rates to be lower than current rates. And, if they expect future rates to be lower than current rates, then they expect a recession, basically. Why else would rates come down? Now, there is a theory, right? I mean, so there's something that's not happened historically, but is a legitimate theoretical idea, which is, well, they could just believe inflation is going to come down, right? These are nominal rates. So if you just believe that inflation is really high right now and it's going to be really low in the future, that could explain an inversion. So that would be the argument that you could make, that may be the reason why. Basically what it means is that money is too tight, though. It's tighter now in the moment than it should be on average in the future. That's what it's telling you if you have a higher 3-month rate than you have a 10-year rate.
How do you think all of this recession talk and layoffs that are going on currently, how do you think that will affect entertainment stocks? Did you have a chance to take a look at Disney? Their most recent quarterly earnings, I think they reported, was it yesterday? Then you could look at like SeaWorld and then Cinemark. I mean, obviously we spent a lot of time thinking about entertainment.
Mm-hmm.
Why is it that like attraction businesses or entertainment has historically been pretty recession resistant?
Right. So it's been pretty recession resistant. Well, it depends. Disney, like their major theme parks, is not very recession resistant versus, say, something that's a local park. It's the same difference between, like, say, Las Vegas and some local casino. The small local casino is more recession resistant than the Vegas casino, because it's not drawing from all around the world. So people can trade down into these things. Generally, stuff like admissions to SeaWorld or Six Flags or a movie theater, a movie ticket. People complain about them. They say, look how expensive it is to go to the movies and everything. It's actually pretty cheap versus alternatives of how you could spend your time and your money. So that's a big part of why they are pretty resistant in recession. Other possible reasons are, less clear and a little more speculative as to why, like, certain things, entertainment, vice things, stuff like that, seem to be more resistant in recession. Could be people prioritize those things more than other sorts of stuff. We've talked about, like, I think I've talked about, in a recession or something like that, people will stop eating healthy. They'll stop going to the gym. They'll stop, that's the things they actually cut. The things they don't cut are like entertainment, which may be different than what people tell you they're going to do. But in reality, they don't usually stop drinking alcohol, smoking cigarettes, smoking other things now. And all of that, they do cut back on some other things. So I think short-term instant gratification stuff, they tend not to cut back as much on, and many of these things are pretty reasonably priced versus other sorts of expenses that you might have. So they're things that people don't put off. But things like Disney's parks, they do. So, Disney World and Disneyland to some extent, Disney World more so, those things do decline in a recession, and they decline a lot more than, say, Six Flags in Texas or whatever, if it only draws from the Texas area. The smaller your market area that you're drawing from, the less affected you are in a recession. The larger the area, the more of a destination you are, the more affected you are.
So basically what you're saying is regional businesses where they're just pulling from maybe 100 miles around the park, they're more insulated from a recession compared to like a Disney park where you have to hop on an airplane, book a hotel, and fly over to, the destination to enjoy the amenities. That's the difference between the two.
Right. But I do want to stress that I'm just talking about this from the perspective of demand. It doesn't mean their earnings will be okay or will be better or whatever, because sometimes when we talk about a recession, it's easy to forget this. We're talking about something now that's very different than, say, 2008 or some other periods. It can also be that they have increasing costs or costs that increase more relative to some decrease in demand. So in the past, it might be, oh, well, there's a very small decrease in demand, but there's like no increase in costs, so it wasn't really too bad. If your costs are increasing pretty quickly, at the same time there's much of any decrease in demand, and this is what we've seen in tech, right? Then things can be bad from an earnings perspective, even though from a revenue perspective they don't look that bad. And that would happen, in a even a mild recession if it was accompanied by pretty high inflation, like really tight labor markets for the sorts of attractions and things that you're running. So it's totally possible that you can have bad results, especially if you have meaningful inflation and stuff, because all of them are affected somewhat. It's not like you benefit from a recession. Overall, people spend less on entertainment. Some of it, though, goes to you as opposed to other things that it would go to otherwise. So there's some trading down and all of that. But there is still a decrease in like real terms. And in really bad recessions, we have evidence that it is very meaningful. So like the best examples we have would be, so these are mostly done like nationally, and I think that obscures some things. So they'll do like, national, how much did it drop for these industries. But we can see, for instance, that in the early 1990s, there was a real estate bust in California, and that clearly affected Disneyland. Disneyland draws a lot more locally than Disney World does. Likewise, there was a crash in oil-related stuff in Texas, and the Texas parks, you can see clearly a big decline for them. At the same time, in those same recessions, you don't see as big a decline in other parts of the country for Florida and things like that, but Florida didn't have a particularly bad recession in that period. So they're really comparing off of national things, and that, I think, obscures it a little bit. If you have something that's as bad as those periods were in your local area, then you'll have a real problem.
Why do you like the attraction industry so much? Is it because of, it's predictable? Is it because the industry's been around for so long? Is it because of the economics of the industry? Why do you spend a lot of time, focusing on this industry?
Well, I think it's the same as like when we talk about supermarkets. I don't know that I particularly like it or don't like it. I guess I like it more, same as with supermarkets, than other people do, in the sense that I think it is more predictable, and if it gets cheap enough, then you can be pretty sure that you have a good deal. It's not that it's a particularly great business. It can be. Some of them can be pretty good businesses. Over time, their returns are okay. Once they're, the history of attractions in the U.S. of once they're money-making, is okay. The reinvestment on it has like an okay return on capital. As long as they use some debt, it does generate value over time. Without any debt being used, if it was 100% equity, it barely creates shareholder value, I'd say. And that doesn't take into account that some of them fail in the beginning. Now, once you're established though in a particular location, you tend to have, I'd say the returns on capital are okay, and they're fairly easy to leverage up, and so you do create shareholder value. Where shareholder value is destroyed usually is only in like trying to move into new places or acquire things or something that is different than just reinvesting in existing attractions. So I think that when they're cheap, it's fairly easy to tell that they are cheap because they're fairly durable. But that is similar to other things we've talked about, like supermarkets and car dealers, which I think people have the impression that I think they're better businesses than they are. I don't. I think they're more that I think that the fact that they're incredibly durable means that when they are value stocks, they are more attractive value stocks than some other that they're more attractive as stocks. So when we have them at the same EV to EBITDA, the same PE, the same price to book, whatever, of certain other companies, I think that some industries that we've talked about, like attractions, they are more durable. They're very durable. And so that means that as long as you're not paying too high a price, you can know for sure that you're getting a good value, I guess. So I just think that as a value stock, when they get to those prices, you have a higher degree of confidence in some industries, and this is one of those industries. But it's not alone. Supermarkets, car dealers. We've talked about things like aggregates and stuff like that. Those all share those same features. So as compared to some product or technology thing or something, it's a much safer thing to bet on when it's cheap.
I'm trying to see. I was looking at a slide from Cedar Fair, and they didn't have I can't find one that I thought they said they had a study on successful regional theme parks and how hard it is to get a regional theme park successful, but basically how resilient it can be once you have a successful theme park, up and running for Cedar Fair. They had that in their investor presentation.
Yeah, the only thing I'd caution with that is, the problem with all of these is the same as we say in a lot of industries. The actual returns that they get on their reinvestment usually aren't that amazing. They're okay, but the best returns you're going to see is when they kind of underinvest in them, and they get good results without putting in a lot more money to grow it. It's fairly hard to put in a lot more capital to grow it because they're pretty capital intensive. And we talked a little bit about that with Six Flags. I had said, I think Six Flags underinvested in some things for a while, but that obviously looks good on a financial performance basis in those years when they did do that, because you can afford to put almost no money into it. And for a few years when you do that, you don't see big drops in attendance or anything like that. But it's not as easy as some people might think to put $100 million in it and drive a big good return in the business from doing that. So it is hard to drive much in the way of additional attendance and per capita spending. So the results are good, but they're not unbelievable that way. And so I'd be careful about paying very high price to book and all those sorts of things. I just think you want to look at it in terms of what it's actually throwing off today and valuing it that way, which means you need a pretty reasonable price versus, EV to EBITDA. We talk about price to free cash flow, those sorts of things. It has to be pretty reasonable and not based on the idea of a lot of growth. You can see that here with Cedar Fair, right? So last 10 years, they peaked their revenues in, I guess, 2019. So this is not giving them enough credit. But their revenue really didn't grow much more than inflation over that 10-year period. So the returns obviously were okay because they didn't really grow assets that much or any of that. Cedar Fair basically pays everything out.
Do you think the play is for these companies then is to just take cash out and either buy back stock or pay dividends? I mean, when you say a lot of the returns that the companies get from reinvesting into their business normally aren't that good, then like most companies, it's what do you do with that cash, right? Do you think they should just return to shareholders via buyback or dividends?
No, I think it's fine to reinvest. I just think that you need to use debt to do it. So you need to borrow long term to do it with debt, and you need to mix debt and equity. I think it's like a railroad or utility or any of those things. I probably wouldn't want to invest in a railroad or utility that only use shareholder money. Then you need to use debt to do it. So I think it's fine to reinvest in it. I think the returns are there in many cases. And the returns, the acquisitions, unless they're very well timed, often don't have returns that are all that much better than simply reinvesting in what you already own. And it's tempting to do the acquisitions, obviously.
Mm-hmm.
But these aren't bad results from Cedar Fair over that time, because they're able to keep down the growth in assets, and it's not a very fast growing business there, as you can see. But if you don't grow assets at all, then you can get good returns.
What are your thoughts on like SeaWorld compared to Disney or Cedar Fair?
I don't think SeaWorld's that cheap.
Yeah, if you're looking at it, EBITDA sales 3.5 times, PE 13.6, which I mean, for all these companies, it's kind of skewed really since 2019. EBIT free cash flow 15.6, but I was looking at their per capita spending, total revenue per capita 77, and admission per capita or in park per capita spending. I mean, it's pretty damn high. And if you look at most theme park companies, they're up, certainly over 2020, 2021, but, also up above 2019. I wonder if coming out of the pandemic, they were sort of forced, SeaWorld, Cedar Fair, Six Flags, Disney theme parks, to, like most companies, to really hone in and bunker down and, remove excess waste and improve like the economics of their business per person that visits their parks.
Yeah, I mean, their attendance isn't down, at least, so that's a good thing. I think for most of them, the problem, and movie theaters are the same thing. I think it's somewhat exaggerated, the increase in per capita, because the amount of people that you can serve has declined. And if you decrease the amount of people that you're serving, then your per capita numbers will go up, because you're eliminating more marginal people. So you have your super fans, basically, are the people who are coming, are accounting for a greater percentage. And I think it's definitely true when we talk about most of these. It's certainly true with movies, right? So I think permanently it will be higher, but I don't think that, if they get back to some of these companies, movies are the best example because their attendance is way down. If they got back to the attendance they had before, I think they would have lower per capita numbers on the higher attendance level. I think per capita would be high compared to what it was before the pandemic, but it wouldn't be as high as it is at their moment where they have the lowest attendance. With very low attendance, they've had very high per capita because they have the most diehard movie-going people that are the ones showing up.
Cool. Well, in today's podcast, I wanted to spend some more time going through a screener that I screened for some stocks. And last week, people said that they really enjoyed us going through it, and like that we are going to do this basically every podcast. But what I will do is I will just pick different screeners, always have some sort of valuation on it, some sort of qualityness to it, and then we'll just pull and go through it on Quick FS. So what we used for today's screener is market capitalization, 300 million to 2 billion. We have our own volume study on it, which helps find these less traded stocks. Positive EPS over a certain amount of years, something with the Z score, something with the F score, and then a return on equity greater than 10%, and I believe a price to earnings of less than 15 is what I did. I ran the screen, it spit it out, and we have about 91 companies. And just looking through some of these are all names that people would recognize, have some familiarity with, which I think would be good to go over on the podcast. And we'll just start to work our way through it and see what we come up with.
And we're using, like I said, Quick FS for this. Quick FS.
Yeah, we're using Quick FS, correct. And again, I want to make the podcast, Geoff and I want to make the podcast as timely as possible. We have our timeless content, but we also want to talk about stocks, right? And currently, with the market being down 21%, I think it's good to spend a lot of time running different screens, looking at as many different stocks, turning over as many different rocks as possible, and seeing what we could come up with for everybody. We'll never run this screen in the area of the market that we focused on, just because we don't want to compete with ourselves. So first one, RGR, Storm Ruger and Company Inc.
Guns.
This is a firearm company. That's correct. Together with subsidiaries, designs, manufactures, and sells firearms under the Ruger name and trademark in the United States. Beta 0.40, share turnover 183%. These get pretty volatile at times when things politically or socially or stuff that's going on in the news hits the fan. Price earnings currently about 8 times. EBIT to sales 1.2. 10-year median margins on EBIT 18.7%. 10-year CAGR in revenue 8.3%, going from $492 million in 2012 to $731 million in 2021. High growth in assets 8% compounded over 10 years. Return on equity, median returns 31%. EBIT to free cash flow about 8 times. If you look at the return on invested capital, you could see, there's some years where they make a ton, north of, 50%. In 2012 it was 60%, and in 2013 it was 81%. And then there are some years where they 2004 2005 it was basically 0 to 4%, and in 2019 it was 10%, but basically all over the place. Any thoughts on RGR, Geoff?
So it has volatile gross margins. As you can see, the return on equity and gross margin are similar. So the changes in the gross margin are pretty reflective of what you'll have changes in like return on equity. Which means that they must have fairly high, and you can see this by looking at the numbers, but they have to have fairly high turns. They have to actually have a lot of sales relative to their assets for that to be true. Usually we like businesses where the gross margin is more stable. I would say this has to do with volume. So this is probably a business that the gross margin depends a lot on the total volume of demand. We can tell what that is. And so that is driven by something. I don't know what we want to speculate on what that is. Obviously, I think the market and looking at the return on invested capital comes up with theories that it has to do with political cycles where for some reason demand is pulled forward because of one party or one president or whatever winning, or being predicted that they will win, or they might win, or they might do something, or they won't do something. And then that may shift demand that would otherwise be pretty steady into certain periods. So it makes it more lumpy. All right. And that seems to be what we're seeing here. So if you're doing something like what this company is doing, car company would be the same thing, for instance. Auto parts would be this would be the case. Chemical company would be the same thing. The gross margin may be driven mainly by the total amount of volume of the same sort of thing that you're doing in a particular year. And you may have particularly bad gross margins in years in which you have low production levels because you have high overhead cost absorption. That's almost certainly what's going on here. So we see this with semiconductor things, for instance. So their gross margins are very unstable because there isn't a stable level of cost per unit. The level of the cost per unit depends a lot on how many units you're making. So if they make an incredible number of units in a particular year, their costs are lower and demand may be pretty high. Their margins look very wide and it looks like a really good business. And then in years in which there's low production, it would reverse that. I would be really cautious about buying at the wrong time in the cycle, right? So obviously on like price to book versus the long-term return on equity average, and it looks okay. I've certainly had lots of people, I have had a few people email me asking about this company. I don't have a strong enough opinion about it because I don't feel like I have an idea of what normal level of demand would be.
Do you think it's hard to come up with a normal level for this company just because it could be so all over the place with, political uncertainty or social unrest and things that make these companies go boom and bust? I mean, I remember in 2020, I was actually in a gun store in Texas with somebody, and the person that was purchasing a gun was talking to the store owner. And of course, there was a long line because everyone was worried about COVID. And the store owner was kind of laughing. He's like, yeah, I'm going to buy all of these guns back for like 40 to 50% less over the next few months. Just because that's how, boom and bust these things can be for people.
Yeah. And I think the issue with that, when you look at this company's results, are if we look at like, let's say 2019 to 2021, okay? So the increase is like 320 million in sales, but I believe the gross profit increase is 180 million. So that means that the marginal contribution to profitability is very high. So it's really the issue of how volatile the gross margin is in that cycle that you're talking about. And that's what concerns me. And that's what you can see in the early 2000s. Now, the company's probably a very different company. This is basically a magic formula type stock. So, it's my usual sort of thing about that. If you're not buying at a bad time and it's a durable company, this is going to work out. But my problem with the magic formula is always it doesn't really express an opinion about that. And so you have to judge that for yourself. Is this a very durable business? Probably. It's probably pretty durable in terms of its competitive position, all that. It's not something where a lot of new people enter and everything. Do you have a good idea of what normal demand looks like though? So it's basically a magic formula type stock. If you buy a ton of these, and you don't do too bad with them in terms of always picking the wrong timing, I think on average they'll work out okay. But I think it's hard for me to know what a normal level of profitability is here.
Mm-hmm. Okay, let's go on to the next one. Heartland Express Inc. HTLD. Heartland Express Inc. Market cap 1.1 billion. EV 975 million. Industry, road and rail. Together with its subsidiaries, operates as a short to medium haul truckload carrier in the United States and Canada. Interesting. Was founded in 1978 and is headquartered in North Liberty, Iowa. Beta 0.54. Current PE 8 times. EV to sales 1.5 times. 10-year median margins on EBIT 11%. 10-year CAGR in revenue 1.4%. 10-year CAGR in free cash flow 10%. If you look at gross margins, they've ranged from 20% to, it looks like lowest was in 2017 at 14%. What are your thoughts on this company, Geoff? Anything that sticks out to you?
Yeah, I mean, again, it looks fine on the price to book versus like revenue versus like the long-term return on equity. Those things look fine. The things you mentioned about earnings or free cash flow look okay relative to things like revenue. Some things don't necessarily, and we'd have to look at the balance sheet to see that. But you'll notice that, for instance, over a long period of time, revenue has not grown that strongly versus assets, but that may be that there's some sort of intangible assets that are causing that problem. On the other hand, free cash flow conversion has been extremely high. So, for instance, median free cash flow margin is actually above the EBIT margin, and it's pretty close to the pre-tax income level. So they're converting a very large amount into free cash flow. But on the other hand, there seems to be something going on there with very poor growth in revenue over time. So I'm not sure what that's about. You also see that return on invested capital has been trailing somewhat lower, almost, very, very slight trend, but it's a very consistent trend for the last 10 years or so.
Mm-hmm. And when you're talking about return on equity and price to book numbers, what you're basically doing in your head is you're taking their 10-year median return on equity of 13.1%. In your head, take 13% and you're dividing it by the current price to book, and which gives you 9.35%, just as kind of like a going forward return. Is that how you're thinking about it for everyone listening?
Yeah.
Got it. Do you want me to pull up the balance sheet so we could take a look
Sure.
at it?
Yeah, so you have a large growth in goodwill over time. So they acquired stuff. And so they seem to have acquired stuff that was not helpful over time in growing revenue, or maybe it was helpful, but it only offset what would have been otherwise revenue declines for them. It's not a PP&E issue, actually. If you look, the PP&E has not grown too much. It's in the last 10 years, or at least the last 8 years or so. So there was some acquisition stuff, which I think accounted for much of the assets change that I was talking about.
Mm-hmm. Let's look at the cash flow statement because of the free cash flow conversion.
It's very
back some stock.
Yeah, so it's very lumpy. because the CapEx is lumpy, but the cash flow from operations is not. The cash flow from operations is pretty predictable because the depreciation is very predictable. And the net income is fairly predictable, actually quite predictable for the last, except for this most recent year, was very predictable for a long time. So the combination of those things and the fact they don't really have working capital, obviously, I mean, there's slight changes in it, but it's not big, means that it's really just the level of CapEx. However, you can see the CapEx is very, very lumpy. So trying to predict the level of free cash flow is hard, and I wouldn't use any 1 year's free cash flow. For instance, it would show huge free cash flow in 2021, and it would show much more modest cash flow in 2020, but I don't think 2020 was actually in any way a worse year than 2021. I just think they spent more on CapEx. So I would, use like a 3-year average cash flow from operations or something, probably. In this case, there may not be much difference between using EBITDA or cash flow from operations because obviously they don't have a lot of working capital. So it's much more of a straight up net income and depreciation. So if you were going to use EBITDA for a business, EBITDA would be okay for this business. This is the kind of thing where it'd be okay.
You think you'd ever be interested in a company like Heartland?
Probably not.
And why is that?
The industry that it's in. Yeah.
Got it. Cool. We can go on out. Let's go to a name that I recognize. HIBB. Hibbett Sports Inc. Market cap 788 million. EV 759 million. Specialty retail. Valuation 7 times PE. EV to sales 0.5 times. 10-year median margins on EBIT 11%.
This is like a small format Dick's, if people know Dick's. This is like that, except small format in more rural places, in places where you want to put a Dick's Sporting Goods. But it's basically the same sort of idea, just really small in strip malls. Yeah, incredibly volatile stock. It's just a retail thing. I would avoid those things. I think there is some built-in demand for it that isn't stuff that you would buy online, that you would buy in person, but it's very tricky. It's like Bed Bath & Beyond or Best Buy or any of these that get into risks about online versus will people keep buying it in person. I don't know enough of that. It's certainly, again, looks really attractive on like a sort of magic formula type thing. It's been cheap in the past a bunch of times.
Mm-hmm. The Monarch Cement Company is the business that you've written about. This only has financials going to 2017. So
on QuickFS, yeah. So
on QuickFS,
I would skip it because QuickFS isn't updated, but the company does keep putting out financials. You can find in their disclosures. Yeah. So you just have to calculate the information for yourself. You can't do it otherwise.
Mm-hmm. They had a pretty good year, or they've had a good run, I should say, right? So since 2020. The stock was, you could pick your lowest point around $50, and now it currently trades at $99, and it had a peak earlier this year of about $130 per share.
Mm-hmm. They do have a portfolio of stocks, which includes things in materials things, but also could be like home building things, could be oil and gas things. So sometimes they do have reported like changes to net income that's based on that, and that doesn't always go well when the stock market's down. So that could obscure things a little bit. But so everyone, that's unusual. We don't talk about many stocks that have like an equity portfolio, sort of like Berkshire Hathaway does. This company does. They don't disclose a lot about it though.
Zumiez Inc. So another retailer, a current market cap 437 million, EV 271 million, specialty retailer. Does it say how many stores they have? They have the company operated 738 stores, including 602 in the United States, 52 in Canada, 67 in Europe, and 17 in Australia. I think anyone that has been to the mall
knows it's a skate and surf.
Zumiez.
Yeah. It's basically yeah. I would not look at it. I can't evaluate something like that,
Too much ties to malls?
No, I'm sure when I started writing Gannon Investing, I think I mentioned, at the time that 15 years ago or whatever, or a little bit longer than 17 years ago, I think we mentioned one of the first things I wrote about was American Eagle. I mentioned that at the time, like PacSun would have been a major stock this is in that category. So it's a few $100 million market cap now. Some of those go on to be a couple billion if the concept does well, and some of those go to zero. I can't evaluate things in that category. As I think they said in their description, it's basically apparel sales and accessories and shoes to young men, and it's mall based. So it's not super predictable, the demand, and I don't have any insight into their competitive position and all that over time. It's trendy and changing all the time, and we talk about Buckle on this podcast. People always ask about that. Same sort of thing. I don't really do retailers. I don't do specialty retail.
Yeah, we've talked a lot about Buckle on the podcast. Okay, let's go to ULH. Let's see what we could come up with. Universal Logistics Holdings, Inc. It is a market cap of $941 million. Another one that's in road and rail. EV, $1.3 billion. Universal Logistics Holdings, Inc. provides transportation and logistic solutions in the United States, Mexico, Canada, and Colombia. It offers truckload services, which include dry van, flatbed, heavy haul, and refrigerated operations, domestic and international freight forwarding, and a bunch of other stuff. It was founded in 1932 it's headquartered in Warren, Michigan. Current EV to sales 0.6, 10-year median margins on EBIT 5.8. That is quite the volatile return on invested capital chart on QuickFS. Price to earnings 6 times. 10-year CAGR in revenue 6%. A 10-year CAGR in assets about 14%.
Yeah.
So another one, Geoff.
This one's a little different in that free cash flow is bad. So long-term free cash flow is very slim, and leverage is much higher. So we just talked about Heartland. This has similarities to Heartland, but I would stress the differences is cash flow generation relative to like earnings and stuff is much, much lower here, and assets relative to things like equity and other things, just like the total amount of debt relative to the market value, market cap and all that is high. So this is a much more indebted company, much more leveraged company overall. There's other ways that we can see that on the combination of operating leverage and financial leverage, it's high. And then you don't have as much coming in the form of cash. Overall, probably a weaker credit than Heartland. If it works out, it probably pays off better, right? When you have a lot of leverage in both the operating and the financial, when you get it right, it has a higher payoff. But it just, so there are some differences here between the two of them, I would say.
Mm-hmm.
Similar thing in terms of the growth in the intangibles too, like where we're seeing the strong asset growth. It's really in intangibles. It's like the acquired stuff that caused that. We see again, on the second half at least of their growth, they do have growth in PP&E. It's a lot higher than the growth in PP&E was for Heartland, but a lot of this is also goodwill and other intangible asset growth. So acquisitions.
What are your sort of guardrails from like a debt to equity perspective?
Well, let's look at cash flow from operations first. So let's go to the cash flow statement to see. The first thing we want to make sure is that cash flow from operations is always positive. Here it is, always positive. It sometimes has high CapEx, but even then, usually it can cover the CapEx. In fact, it can always cover the CapEx if we put aside acquisitions. So it's okay from that perspective. Doesn't look very dangerous that way. Let's look at the balance sheet. Let's see. So obviously, total liabilities are very high versus total current assets. And then can we look on a quarterly basis just to be sure? But the other thing is the composition of current assets. So current assets is almost entirely receivables here. And then current assets are also pretty low versus total liabilities. So it's constantly funding from the cash flow from operations, which as we saw is always positive. So that's what they're doing. But on the actual balance sheet basis, they're running things pretty tight. So they need that constant cash flow from operations, which they have. And there's no history of not being able to produce cash flow from operations from what they do. But on a static basis, no, it's a weak balance sheet.
You think when Buffett would look at the value line, this is exactly what he would do? He would spend about a couple minutes on each stock, look at the numbers just like we're doing here, and either, pass or dive in more?
Yeah. This is a screen, so this is unfortunately what happens with screens. What tends to happen is that I would say on the quantitatively, I'd say quantitatively it looks fine. Qualitatively, it has issues with me of why I wouldn't like it. Because what we did is we screened for the quantitative aspect of it. When you flip through a value line or something, you go, oh, this is too expensive. I like the business a lot. Here, we're going to have time after time where I'm going to say, here are my concerns about the business. Obviously, all of these that we're going to hit, the prices are going to be, most all of them, the prices are going to be pretty reasonable. But there's going to be often some qualitative thing, mainly just what industry they're in.
Uh-huh. Well, in the future, I could take the valuation thing off. Like I said, I'm just going to do just a bunch of different iterations every single week and just pull a bunch of different stocks. So in the future, I could take that valuation aspect out of it, and we could just, maybe come at it more from a qualitative perspective.
Yeah, sure. But these are also, you have good prices on them. So
what do you think's better? Where do you think it's better to spend your time? Doing what we're doing now, or the alternative?
I've done both. I think that if things are incredibly cheap, it's fine. But what I said about the entertainment stuff, I think is something to keep in mind. I would buy cheap entertainment companies. I wouldn't buy cheap. There's not really a price at which I'd say Zoomies is so cheap I've got to buy it. But there is a price at which I'd say Six Flags is so cheap I'm going to buy it. Because I think there's a predictability to Six Flags, if the financial strength is there, if whatever, that I'm not sure if there is with Zoomies. You have to ask with each of these, what really is this company? What's the durable part of it? And what does that really consist of, right? Like, we talked about gun manufacturer. Okay, so they have certain brands and things that people are familiar with. It's not an industry that a lot of new people are going to enter. There's a lot of history there. You can kind of understand what there is there, and that of the things we've talked about is the one that has the most substance to it as a company. With some of these others, okay, well, if you had as many trucks as they have, if you have, what exactly is it that they are that that same collection of assets or whatever, from someone else wouldn't be? What is their actual lasting thing about their organization? It can be mindshare, it can be the organization in terms of, brand names, and it could be the actual locations of things. It could be whatever, but what is that? And in most all these cases, we're talking about paying a premium to book, right? Usually, sometimes a small premium to book, but if your trucking fleet thing, why am I paying a 50% premium to book? If you look at like the magic formula type thing, you just think of every business as a business. If you buy it at the right time, it might work out. You think about the PE and everything, but I'm willing to pay a premium to book for a collection of amusement parks, probably in a way I'm not for a trucking fleet. I think there's something unique there in one case that probably isn't there in the other. With something like Zoomies, there may be something very unique there and lasting and everything. I just don't know. It probably will produce either really great returns on capital or we'll lose a lot of money at some point. It's probably not going to be an in-between thing. It's not going to start earning a 10% return equity year after year. That's never going to happen. It's going to earn really great returns and or at some point it will lose a lot of money. It won't be consistently making a little bit.
Okay, so we have PRIM, Primoris Services Corporation, if I'm pronouncing that correctly. It's in the construction and engineering industry. It's a specialty contractor company, provides a range of construction, fabrication, maintenance, replacement, and engineering services in the United States and Canada. Just from what you basically said, I completely understand. You probably, a lot of these companies, no matter how cheap they are, I don't know if you'd actually be interested in them. Headquartered in Dallas, Texas.
Yeah, you can look at their balance sheet. Generally, the problem with these is they produce no free cash flow, really. So unless you buy them at a really good price versus the balance sheet, like on a liquidation basis, there's not a lot to go on. There's some risk sometimes in these, depending on what kinds of things they're doing, that they could actually have meaningful losses if they get jobs where they end up overrunning what they were planning to do. So what's our current total current assets?
1.3 billion.
And so what's total liabilities?
1.6 billion.
Yeah, I would not buy it. I think for a construction company, I definitely want current assets to exceed total liabilities, or else I'm probably not looking at it. And I'd be most interested in ones that are basically nets. But it is a little risky to buy any construction company where, I mean, some of this is deferred revenue. So it's not a huge item here, but it's a few $100 million. So I'm not saying there's anything wrong here. For a construction company, probably I really want current assets to exceed total liabilities here. Here you have like goodwill and PP&E. Those are not things I'm willing to pay for a company like this. So I really need it in the form of cash and receivables. And there are some, I've seen them before on screens and stuff where they are okay on that. Usually though, the ones I've found that are good on a current assets minus total liabilities basis, in fact, cheap, have problems that are known, like they're going to lose money in future periods because they've committed to jobs that they're going to lose, that they realize they're going to lose some money on, and those jobs aren't run off yet. So you're kind of betting on how their bidding and stuff will be in the future if they'll clean up and get more disciplined about that. But the good news on those is that you often have like, you're paying a very low price relative to the liquidation value of the business, basically. So it's kind of like an insurance company. If it decided I'm going into runoff, you get a good price. It's just that you're kind of counting on, it's known that they've had problems in the past sometimes. I would definitely want, with construction companies, really strong current asset position versus total liabilities. I would buy them on the balance sheet. I really don't think I would buy them on and like on an earnings basis or something like that, probably.
Yeah. Let's look on CSV. Carriage Services Inc. Diversified Consumer
That's
Services.
not what it is. It's not what it is. It's a funeral home operator. That's just
Okay,
a
so
euphemism for some reason. Yeah, this is a pretty well-known one. Yeah. That's a pretty known one.
There you go. I mean, kind of consumer services, right, Geoff?
Yeah, diversified consumer services. Yeah.
Yeah, operates through two segments: funeral home operations and cemetery operations. Let's see. As of December 31st, 2021, it operated 170 funeral homes in 26 states and 31 cemeteries in 11 states. It was founded in 1991 and is based in Houston, Texas. Beta, less than 1.98. Share turnover is quite high. Let's turn this quarterly to annual. Valuation ratios, EV to sales 2.6. 10-year median margins on EBIT, 19%. Valuation from a price to earnings perspective, 8 times. EBIT free cash flow, 27 times. If you look at return on equity, 10-year median returns, about 11%. So on a price to book basis of what Geoff was, or what Geoff uses and what we were talking about earlier on, is if you take about 11% and you divide it by price to book of 3, well, you're thinking of like a go forward return of about 3.6%. 10-year CAGR in revenue is 7%, going from 198 million in 2012 to 376 million in 2021. About their capital structure, right? If you look at their market cap to EV, these companies, all of them, have typically a tremendous amount of debt. And you can see right there, long-term debt, 552 million, short-term debt about 1 million, and we could go to quarterly so we get more updated, but it doesn't look like it's changed. Yeah, so long-term debt 566 million, and cash, this looks like 1 million, unless it's less because we are in millions. Let's see, $821,000, Geoff. So a lot of these companies always run pretty levered to the hilt.
Yeah, that's basically like an LBO. Basically.
Yeah.
I mean, that's how it's structured here. So free cash flow into which, the way it's reported in the United States and stuff, is after taxes and everything. So it is cheap, right? So like you're getting, like, if you're trading at 1x sales in terms of price to sales, and your free cash flow is 13-14% of sales, your margin, then your free cash flow generation relative to your price is good, but it's incredibly leveraged. And so that's why it's good. And they don't want to unleverage it. As you can see, they've even bought back stock recently. So I think this is really only showing up as cheap because it's incredibly highly leveraged. Of course, what's a more predictable sort of business than the death care business? It may be declining over time, but it's the kind of thing that you could put, an LBO type structure to it and make money from it. I evaluate the people involved, their strategy and all of that, and decide whether you want to get to do this or not, with the understanding that what you're doing is basically like an LBO. It's like when we talk about TransDigm or one of those, that's the structure that they want to do, and you're going to be on it permanently, probably, doing that. So, like if we look there, they even issued more debt. They haven't paid down the debt. They've actually bought back more stock than they paid down debt in the last couple years. They did pay down a little debt before then. But you can also just see it in the extremes. And like we talked about with the balance sheet, that their total current assets were like 40 million, none of which is cash. And their total liabilities is over $1 billion, of which a lot is long-term debt. We can check cash flow from operations. I actually think this is a little too much for me. So their best cash flow from operations year, which I would use instead of like EBITDA, that's actual cash flow that they generate. And I'm not even taking away the fact they use stock-based compensation. So I think this is fair. Was only a little better than 80 million. If we look at their net debt, so on the balance sheet, we can see the long-term debt was 550 million, right? Yep. And then you have no cash really, so you basically have, there's some other items in here too. I would say you have 7 years worth, 7 times. So your net debt is basically 7 times your cash flow from operations. That is pretty consistent with an LBO, but it's too much for me for investing in it as a public company. So it's very high level. It's not what people listening to this are used to investing in a company with that level of leverage, but it is this industry, and those ratios and stuff are totally in line with what LBOs look like. And LBOs, don't have a bad record overall as like a group. So I'm not saying it doesn't work, but this is a whole different kind of investment than most people are used to making.
And what are they doing? Just acquiring other funeral homes and cemeteries. They have a good amount of goodwill, right? So of their $1.1 billion asset on their balance sheet, about 400 million of it is goodwill.
Yeah, we could look at let's look at their income statement annually. Look at their share count.
Yeah, so the share count is actually, it's been the same since 2012.
Right, but they increased it, right, and then they decreased it, or what did they do? So they've they've increased it for acquisitions, and they buy back stock, or what?
That's basically it was 18 million in 2012, and then in 2013 it jumped to 22 million, and then it's really gone from 18 million and then stayed in that area. I mean, we had 18 million, 17 million, 18 million, 18 million, 18 million. So hasn't jumped around too much.
Yeah, we can also look at so like cash flow from operations, operating profits, so EBIT and cash flow from operations are both around 80 million recently. If we look at the overview, we can see the market cap and the EV, get an idea. They are reasonably cheap on a market cap basis. Yeah. On an enterprise value basis, they are somewhat cheap, right? So like paying for this kind of business, paying 10, 11, 12 times cash flow from operations, which is what we're talking about if it's 80 million and the EV is 950 million, is not that bad. And you can see that also in the EV to EBITDA. It's not that far different. I usually use cash flow from operations to get at the real cash that the business has, but this kind of business doesn't have a lot of like working capital or anything like that. So the EV to EBITDA is a pretty accurate, it's EBITDA is a pretty good proxy for actual cash flow from operations. It is a pretty good cash flow measure here. It's not expensive. I wouldn't say it's necessarily all that cheap either, but 10 times EBITDA or 10 times cash from operations or whatever, is not an expensive price to pay. It is mostly, literally, mostly, debt.
Mm-hmm.
You're using maybe 2 parts equity for, 3 parts debt or something like that. Maybe 40% mix of equity to debt here.
Let's look at a chart of it. I'd be curious to see. There's been some value investors that have taken some pretty big hits on these funeral homes.
Well, I mean, some of these, I don't remember if carriage services specifically is mentioned in One Up on Wall Street, right? But the Peter Lynch book. But he does talk about at least one of the funeral services companies, and how it transitioned from being a company that didn't have debt and everything to being one that had debt and that was a roll up basically.
So Wall Street ruined it.
How's the long term chart?
Long term chart. It's gone from in 1997. It was $21 a share, and it's been as low as $2 to $3 per share, even lower. Yeah, and then recently, through the pandemic, which I guess you could. I do remember funeral stocks going crazy. It was at $63 per share.
Yeah, so it's pretty volatile. Yeah, but that's not crazy. I mean, in terms of the total enterprise value, it's not. Part of that is still pretty volatile. But in terms of the total enterprise value, it's not as crazy as you think, because if most of the enterprise value is debt, then small changes in the enterprise value are changing the equity portion of it, like this, by a large amount. There's a reason why like LBOs being not marked to market is a big advantage for people, in terms of stomaching it. If you took the same thing and put it in the market, it would look much more like this, right? Because if there's we've seen, right, for companies that are, the overall S&P 500, let's say, if we imagine that they're completely debt free, we've seen them come down 20-25% in a year. Now it's an extreme year, but we've seen that this calendar year. So if you imagine their entire enterprise value is changing by 20 or 25%, if you have that happen here, that kind of change actually would, have your stock price or more, because the debt portion, basically, if the debt is still worth its face value, then the equity is absorbing all of that. And so when you have something like Meta, in many ways, right, it's more impressive, the huge decline in that company, because it's all equity. Mm-hmm. So, lots of stocks go down 75% or something, but not many stocks that have some cash and no debt drop 75%. That's, because if the enterprise value of something like carriage services drops 75%, the equity would look like we saw in that part where you're saying it dropped below a few dollars a share. It would drop to like nothing, because there's serious concern about whether the debt's safe. It's impressive when you have something that dropped like Meta, where there's not debt in front of the equity. So that's the entire enterprise value changing by that much. The actual enterprise value of carriage services probably did not change as much as Meta when it dropped from $60 to $25 or whatever, but because there's so much more debt, even though the business wasn't revalued as dramatically as it was with Meta, the stock is, the stock price has moved by not all that much less.
Could you ever see yourself being interested in funeral homes as a potential investment, or is this something that, like, the business model, the act of putting so much leverage on it, is just something that you wouldn't be interested in? I mean, obviously, from like an industry perspective, none of us make it out of this life alive, and it's pretty predictable the amount of people that are going to die every single year. So that predictability element is there, which is why they throw on a ton of debt. But do you think from like an investor's perspective, the actual business model with using all that leverage would, keep you away from an industry like this?
Yeah, it's possible. I'm a little skeptical sometimes of LBO type debt being put on something that's perceived to be incredibly predictable. That's often the way that you can sell things to the public and to lenders and everything, to be able to put on more debt than maybe you should on something, and to be able to get a higher multiple than maybe you should, because I think if you're like rolling these up, and this was rolling things up much more in the past than recently, I think the problem is often what are the actual underlying organic results that we're seeing. And I think they can become very obscured. But one of the things I get the most emails about and I'm the least helpful about is people really bring me a lot of roll-ups. A lot of them. And my answer in most of those cases, after looking at their presentations or their whatever things about their history and everything, it's kind of hard for me to see what's happening with the underlying business. Sometimes I'm not sure the underlying business might be getting a slightly bit worse, and we think it's just staying just the same. We think it's getting a slight bit better. When there's so much financial engineering on something, I think it's hard to know for sure. And so I'm cautious about that, and that just means you have to like management even more. But with the right communication and the right management and everything, yeah, I could see myself owning a company in a funeral home type thing if I really like the management and everything. But it would rely more on that than normal, because I feel like that's the only way I would get to the underlying things. But that's kind of true for all roll-ups. I'd be extra cautious about management and everything. I would never get involved in a roll-up where I didn't really like management and what they were saying and everything a lot. And I'd be very cautious about any roll-up in which I had any doubts about management at all.
I mean, I know Buffett and Berkshire is more so thought of as like a conglomerate as opposed to I'm going to go roll up this industry. But, he's made a decent amount of investments in insurance and, different businesses in the same industry. So, but from that perspective, it's different because obviously you trust Buffett, you understand, sort of his capital allocation framework. He's not crazy and never going to lever up, a gazillion to none. So do you think it's just different from like that perspective that you just would have a lot more trust in Buffett doing it versus some of these other actors in roll-ups?
There's nothing right or wrong about the structure of it and the fact that they're doing it.
Got it.
If you invested with Buffett and you invested with Singleton, you made a lot of money. If you invested with most of the other famous conglomerates from that era, you lost a lot of money. And it wasn't all just luck that you couldn't have foreseen. Their attitudes were different, and some of that was known at the time that their attitudes were different and their personalities were different. And if you explored that, I think you could have figured out which people would have been safer to go with and which ones you might want to avoid. But yeah, no, there's no doubt Buffett based it on his part of his approach that he learned was the value of being able to do a conglomerate that way with people who used it for very different purposes. And so they used it in a chain letter way of trying to drive higher and higher stock price with a lot of earnings manipulation, and which is a game that works for a number of years but can't work forever. And Buffett said, okay, how do I do that same thing and do this as something that's durable that can last forever, basically, doing it. And it's just it's just the structure of it. I mean, I think we talked last week or something about, would I invest in a stock with class A, class B? If you like the management and you like what you're doing, it's better for them to have absolute control, but it's bad if you don't. And people always ask, well, do you like, there's a ton of insider ownership here. And it's sometimes when people talk to me about something, they say, and look how great this is that there's a ton of insider ownership. Or they say like, well, yeah, there's this questions about management or whatever. I'm not sure about all this and stuff, but they own a lot. They have a lot of skin in the game. I don't want them to have a lot of skin in the game if I don't like them. So I would, if I really didn't like them, I'd rather they be professional management that owns a really small amount and is probably going to be gone, or someone could make a run at the company or whatever. So is it good or bad, the setup at Meta? It depends on if you love or hate what Zuckerberg is going to do there. If you believe in him more than any other kind of management, then it's good. If you believe in Buffett more, it's good. There's no structure that's better or worse that way for investors in terms of just what your overall result is going to be. A highly democratic structure is not necessarily good if like the stock is undervalued. And because basically all that would happen then is you get a quick pop and yeah, you get a good annualized return, but you never realize things over time. The more democratic the structure, basically, the more that you're just, it might sound great to let's have a stock that has very low insider ownership, no debt, plenty of cash. It's really cheap. There's no class A and class B. It's easy to buy the stock. That sounds great, right? But all that gets you, and it's good, but what it gets you is a short pop because there's going to be a run at the company. Something's going to happen. There's going to be a chaos. Whatever activist thing happens, it's very easy for it to happen. And you're just going to put it in play and have it sold. Whereas if you have management stuff that you want to see it play out, how they create value, then actually you want it to be the opposite of what's a good activist target.
So I guess to minimize people bringing you so many roll-ups, I mean, what are some qualities about roll-ups that you like versus ones that you dislike?
Here's the big issue. It's really not a roll-up thing. It's just an issue between how I look at companies and managements and things and how other people do. I'm just very cynical or whatever, I guess.
Okay.
I put very, very little weight, like to no weight on what management is telling me in terms of the actual facts and how to look at their company and stuff like that. I think I spend a lot of time thinking about management in terms of trying to analyze how management is saying what they're saying, in terms of sort of psychoanalyzing management, in terms of what this means that they're saying this to me and everything, and what I think that means about management. But I don't really care what management says in their investor presentation about what they think their company is, what they think it's worth, any of that. I don't think about that. So I'm going to look at it and decide on it my own way. And so there are several times where people bring me something. Look, this is just like a much broader concept than like we talk about banks on this. I don't want to name what banks they are, but people bring me a couple banks. They repeatedly bring me banks that I particularly do not like. And I'm polite in saying, I just, this isn't really for me or whatever. And they have good numbers the last 10 years or whatever, but there's things about management, what they're doing, whatever, that it's not that they're bringing me kind of an average bank or whatever. They're bringing me something that I actually, if we gave lists of, the banks or whatever, they stand out to me in things that I particularly dislike about it, what they're doing, and find particularly risky and stuff like that. And the same thing happens with people bringing me certain kinds of companies, including some companies that, I think have reasonable risks of being frauds, for instance. There's a couple of those that have been brought to me a few times, and I don't know that they are frauds. I mean, there's just things about them that I don't like. The people are charismatic. They present in a way that attracts people and attracts investors, and sometimes in that same way repels me. And I do get brought a lot of stocks that are more in that category, I guess. It's not sort of there's just not a random sample of people bringing me things that I guess it's true, but also just like sometimes people discover something that no one else has found and everything, but these things do get passed around a lot more and stuff if management puts out their story and if they kind of find certain investors and stuff to spread it around there. And so there are just certain ones that you get, there's just like within individual industries and things, there's just stocks that are popular for value investors to talk about or for investors to talk about. Because they use the right words to talk about what they're doing and how they're creating value, and and they dial their message into that, and
I mean, it's kind of part of the roll-up playbook, right? Like, communicate your story, get that premium multiple, acquire private businesses at a multiple that's like 3 to 4 times EBITDA, maybe 3 to 5 times EBITDA, trade in the market at 10 to 15 times EBITDA, and then you get that immediate value creation, right? In theory, from a market value perspective. So, I mean, do you think that the roll-up strategy, if you will, it takes a special type of breed, or there's a special type of person that is going to, because think about it, a lot of these probably are finance backgrounds and they understand that discrepancy between, the private market
Yeah.
multiple and the public market multiple, and then communicating the story and then going out and actually doing it. Communicating it to the market is a huge part of rolling up an industry to get that premium multiple.
Right. And Henry Singleton did that. And then, reversed his course when his stock was cheap and did the opposite. But it certainly was the basis of what he did early on. Buffett did not. Buffett was super secretive, basically. He, wrote letters and continued to sign them under the name of the CEO who, when they're really his letters. So they're, ghostwritten that way. He went out of his way to not draw a lot of attention to the conglomerate that he was creating in the first few years. Then he became very communicative, but that's like 10 years or so after he first starts doing that and really creating a lot of value. I guess I worry about the personality sometimes of the people involved in what they're doing. I think a lot of times people will say, to me, well, they have to get their story out there and they have to put the best spin on it and whatever. And I think there's a danger, whether it's fooling yourself or getting in the habit of talking about things a certain way. I do think that it changes you and your approach and everything to be spinning all the time. I think it can be risky.
What do you mean spinning?
Look, we had a election the other day, right? Politicians, as part of their job, is to go out on the campaign trail and say things and stuff. I think it is not correct to believe that if you say things all the time, it doesn't start to change what you actually think, what you believe, and what you're going to do in the future. I think it does. You hear yourself speak. You are not immune to your own voice that way. And you do change yourself over time by doing that. I think we sometimes have a feeling that it's possible to believe one thing and say something else all the time, and that we can judge that and see that with someone, But I don't think that's 100% true. And I think there's certain things where it can be a little dangerous over time. And I don't love, that we do earnings guidance and this and that of things with public companies, because I think a few of these aren't great. I think for myself, for instance, I think that having too many comments on the record about something and my opinions about whatever, say, stocks we own or things we're going to do or whatever, is not good. It's better to be on the record less and not pound into your own head certain beliefs and things. So it is easier to reverse yourself in the future as you get new facts and face different situations and whatever. So I don't even mean it in like a dishonest way or anything like that. I'm not saying an ethical thing about things. I'm saying just being a good salesman does present certain risks that you would have to inoculate yourself against, or it will start to change your own thinking about stuff. If you're doing something that's slightly risky and you're saying all the time that it's, don't worry, we have it under control, it's safe, eventually you kind of erode the safety that you have in it, because you are slightly exaggerating how safe it is when you're, talking publicly. Because everyone's doing things that have some risks and stuff. And yeah, I think it's better to talk as little as possible about some things and to keep a lot of those to yourself, so you can reverse yourself in the future and deal with the situation as you find it then. And having a lot of statements sort of on the record and convincing yourself of things, I don't think is always best. So it would be nice if like companies' investor relations was completely separate function from their executives and stuff. At a lot of companies, the CFO was basically doing investor relations, which, isn't ideal. Right? Because then the CFO is on record saying, this level of debt to EBITDA and whatever is perfect, and we want to be in this target thing and maybe it is perfect until credit conditions change and stuff, and financial conditions and whatever, and things change in the industry, and then you go, oh, we've been running this the wrong way for a long time, and I need to change my attitude about that. But you sort of convince yourself because you argue against people and stuff with this.
So you think it's better just to be sort of more silent?
Yeah, and I mean, there's been certain situations where, like for instance, companies that have short reports written on them and stuff, where getting in one camp or the other, I think people convince themselves too much that the entirety of the argument is correct when there's evidence that that's not true. So I mean, I won't get into which companies it is and stuff, but I've seen some cases with companies where it is true that there's stuff in the short report which I think is not correct. However, it's also true that there's stuff in it which I think is very much true. That basically, because of who it's coming from and that they are putting out all negative things about a variety of different stuff, people then don't accept as true, even when there's a lot of evidence, some of the accusations that there are.
Do you think that just comes though from like a human fault where people just get so passionate about it, anger comes in, all rationality flies out, and there's like social consistency there to where they could see sort of that disconfirming evidence and just completely ignore it?
Yes, I think that's true. I also think that sometimes it's yeah, I think that's true. I also think that sometimes it's alarming how easily that giving an explanation for something, explaining it, even though it's a bad explanation, is much more effective than not having an explanation.
Yeah.
I'm always surprised by that, how effective that is, right? So we did this because blah, blah, blah. And it isn't it's not a very realistic explanation, you know? So yeah, there's just some companies where I would say, you know, for instance, people say, well, it's not that big a deal because look, it didn't affect this or that. Well, let's take an example. Let's take an example of one that's not like such a current one. This is easier to deal with. Tyco, right? So there's things that people could argue about Tyco. Oh, well, it wasn't really that bad because, so you know, oh, the CEO shouldn't, you know, go to jail and stuff for this, and oh, it wasn't really that bad because it didn't distort this and that for a long enough period of time, and whatever. There's much worse frauds about things. A lot of that's true. There is, however, like very clear what other purpose was some of what they were doing serve except to deceive shareholders in a very intentional way, and that's the only purpose for why you would do what you did. And this has to do with like merger accounting and the way that they handled things that way. But it's not like, oh, you know, like there'll be these stories about, you know, some Fed official trading policy thing and stuff. Some of them will be, oh, I inadvertently filed some paperwork wrong, you know, and this will be treated as seriously as a story about things where people intended to deceive about some stuff. We can honestly tell the difference in a lot of these cases between that. So there's a bunch of cases with companies where they engaged in stuff that there is no logical explanation except we were trying to deceive you about stuff. There's no offered excuse for it other than that. We were prettying up the numbers, you know, like, and this is why we were doing it. And so that does worry me when people say like, oh, well, it wasn't too bad what they did or whatever. It shouldn't be an issue that they're doing it at all. And it's very alarming that they would do that. That they're trying to trick you about certain things.
I mean, I think a good example of that is, right, like we've spoken about SPACs on this podcast, and you had said, you know for a fact, you wouldn't even be interested in a SPAC just because of sort of the incentives from the starting line were so flipped where you wouldn't even want to be associated with an individual that was participating in one.
Yeah, and I think I talked about, you know, because this is more one that's, I mean, SPACs have kind of all blown up and stuff, so I guess we can talk about that. But Chinese reverse mergers is a good example. You know, they're basically all frauds. And, you know, you can't prove that they're frauds. You know, usually it's not that easy to find a smoking gun to prove that they were a fraud at the time. But you have this serious question about why do they exist? And that's what I mean about people bringing me certain things. I mean, sometimes there's a good explanation for it. You know, there's an alternative explanation that at least makes some sense. But sometimes there's not so much, and that they do certain things where there's not as much of a different explanation. And that's what worries me. And, you know, like as an example, I think Sequoia, understood well that Valiant was trying to present things a certain way and was very aggressive that way. And they stuck with the stock because they thought it probably wasn't that big a deal and that they actually liked what they were doing in terms of the substance of it and everything. But I think there was a point where they really understood well, oh, that's just how he is and this is what he's doing and that's why he's doing it. You know, that he's selling things a certain way and that he's, you know, and you probably want to put more weight on that.
As well as huge hedge funds, right? And then you have Munger come out and just say that Valiant is a sewer. And that was like the end of it for him.
Yeah.
Like he's basically saying management is trash, what they're doing. I want to stay as far away as possible from this company. No matter how great the numbers are, no matter how well everything's being communicated, their actual business itself is, it's not good what they're doing. I want to stay away from it.
Right. And that brings up this is sort of a debate because there is some mathematically there, something like Valiant when it's going well, and it's done right. And we talked about Teledyne, we talked about Berkshire Hathaway, right? Finding something that looks not so great to some people, but actually turns out to be great, what they're doing, and that's justified. And the payoff is so big in terms of the multiples that you can make, whereas you can only lose what you put into it, that there is some justification for this, that it is hard to say to people mathematically that look, there's so many stocks you can buy that when you do find something that, you bring it to me or to whoever, and I'm like, this is just, what I can do usually is say, okay, so like these banks people bring, I don't know how this is going to end up and whatever. What I can tell people is if you brought me 20 banks, this is the one of the 20, right? There's 19 out of 20 that I'm more okay with than this. Doesn't mean that this is doing something that's going to blow it up and everything, but this is the tail, in the distribution here. We can do that where, and a lot of times that's true with these things that are these fraud risks and stuff. I can't prove that it's a fraud, but I can tell people what they're doing in some of these cases is stuff that's so aggressive that, you're in this less than 5% category that I'm really confident that 95% of companies are I'm more sure they're not frauds and stuff. But it's hard. And also, like, I've written things about companies and stuff. And it did, it does worry me even talking about it and stuff, because like, I remember I wrote up something once and just kind of casually mentioned why I would avoid it because of an accounting issue thing. And like, it got picked up and put on a message board or something.
And then what happened? Did people come for you or?
No one came for me. And it turned out that they failed to file their financials correctly and stuff. But, so it was a justifiable thing to say, here's the issue. And that's in fact that line item is the issue of why they couldn't file. So yeah, it was possible to identify there was an accounting possibility here and to identify which balance sheet item the possibility had to do with. And the company, failed to file with the SEC because of that. Doesn't mean it's a fraud, doesn't mean whatever, but it is possible to identify things that have particularly high risk that way. What I was saying though is that people are right to say on the numbers though, mathematically, like you can't just, I say it, but I think you could say, look, you don't have to do like what Buffett says, that you can just, there's so many pitches, you don't have to swing at any of them, no one calls you out on strikes. And so if you have concerns about fraud or about like just the level of riskiness of certain things or management concerns about whatever, just as people, that you avoid those entirely because the payoff is so big in stocks. The home runs, it's not a game where you either strike out or hit a single. There's an uncapped sort of potential for these multi-bagger returns. That does mean that if you say, look at Berkshire Hathaway and say, oh, well, let's take the partnership years. He doesn't reveal his holdings, right? So I'm not going to invest with him, right? Because I feel there's too much possibility for wrongdoing and stuff, so I'm not going to invest with them. Well, you missed out on a lot, right? If you've said that, and some people did presumably say, I'm not going to invest with Buffett because he won't reveal the holdings of his fund each year to me, and other money managers would. And so I miss out on all of that. And that's a possibility with any of these. And there are some cases where it, there's some percentage. It's not a huge percentage, but I will admit there's some percentage of things that may have had some questionable stuff going on early on that it then worked out. And so did they wish it into existence? Did it? Mm-hmm. There was some substance there, but there also was some sizzle without stake there that was used to raise money and everything, and it turned into something somewhat legitimate over time. We've actually had some success investing in some companies that management changed and everything, but like in a previous existence had some problems with it, and that may be one reason why the stock gets cheap sometimes. Right, is if you have a turnover from one management to another. Let's take the example of Berkshire. Berkshire, there was nothing wrong ethically with the management that Buffett pushed out, but their capital allocation was not what was going to lead to good results. So getting rid of one management and coming in and stuff, there was a lot that probably that stock was cheap enough for a while, in part because its results had been so bad for a while because of who its management had been. And it took a while for the stock to kind of realize there's a new management here doing totally different things. And that part comes into with any company that ends up in the kind of situation where people say they've cleaned house and whatever, and changed things. They've addressed the issues that people had. There's also just like a similarity between a lot of them, to be honest. In terms of like why it's attractive to people, right? Because the thing with a lot of them is it's a lot of financial engineering, really. Yeah. Because actually creating a lot of value through a real business is difficult. Certain kinds of financial engineering are easier, right? So like if we're saying here's a restaurant versus here's they're totally legitimate businesses. We talk about like Domino's and things. But if I'm going to do a fraud of some kind or going to do something that's ultra risky and stuff, it's going to be structured as a franchise system. It's not going to be structured as us owning the stores. There's more room for us to do things that create a lot of value in the stock market and stuff if we do it through a franchise system and more elaborate deals and stuff than through actually owning them, right? So there's, look, people are attracted to the compounders. I guess that's the simplest way of saying it, right? So they're really attracted to the companies that compound and that say that we can compound and everything. And so when I say here are these, it's not like I say, oh, they brought me a couple of banks that I don't love, and the banks have so-so past records. No, the banks have amazing compound records. That's why they're bringing them to me. And they say they're doing something different and stuff, which is certainly true. They're doing something different, but whether it's different good or different bad or what,
the art to it too, Geoff, could be like so many people could bring you ideas. You could be like, oh yeah, this is great. I like it. It's probably going to be really successful going forward. And they could be like, oh, are you going to buy it? And you'll be like, no, I'm not going to. And a lot of that could come from like just the art of investing, where it's like you could think everything looks amazing and for whatever reason just still not invest in it. So that's why I always try to talk about it's like what gets you over or across the finish line. And it's hard because you can't really give a black and white answer. Every single situation is different.
Yes. I guess we do these where we talk about the stocks that, we go through like a screener or something like this, or we go through Twitter. And I guess what makes the most sense is to think about what am I actually saying and what are you thinking when you're looking at it about why you're saying no. So in a lot of these, I might say no, the price is too high versus what I'm going to pay. Okay, well, keep that on your radar, because that's something that can be fixed very easily, no, because I don't understand the industry. Well, you may understand teen skate shoes and stuff that Zumi sells, I don't understand that, demographic, that the products and all that stuff. But you maybe could learn about that, or you're comfortable making, basing on expert opinion on that about other people's opinions about what that would be. Or say we talked about a gun manufacturer, maybe you do find out that it has to do with certain political wins and stuff. And then you can base that on experts' opinions about that and how to time that and everything. So you can fix those sorts of things. Or it could be based on like that there's the people involved. Now, normally on this podcast, I will not say that as the reason. I will come up with some other reason as to why, I will kind of dodge the question. Because you brought me a stock before where I said, no, I don't like the person running it. No. So it just means like, no, we will never look at that with that person involved. And, that's it. Because I've just made a judgment about that person. Mm-hmm. And we certainly on a podcast, though, we will always avoid saying that. I'm not going to say, look, with this person, we will not invest in this or whatever. Because it's like slanderous, basically, But there are patterns of things that you see. And sometimes, look, sometimes that is the good thing. I mean, we were talking about Berkshire, Berkshire had the conglomerate thing. In some ways, the fact that there were some bad instances of the use of a conglomerate really gave a bad name to that. And that kind of helped Berkshire be undiscovered for a certain period of time. Because there had been others that hadn't done too well. So that's not a bad thing to find a category where this country or this industry or these roll-ups or whatever have some bad examples from them, and here's a really good one. And actually, I've even talked to some people who are aware of that fact at times. And that's good if they have that kind of self-awareness of, okay, well, yeah, we do get that we're trying to do something where there's been some examples of not so good stuff that the market's aware of trying to do this, but we think that we can do this the right way. And Buffett certainly had that awareness with the conglomerates. He knew this is something that had been used for the wrong reasons before. Yeah.
So just how success leaves clues. I'm curious, the ones that don't work out and turn out to be like these huge blow-ups, it seems like when all of the information comes out in the future, it looks so obvious in hindsight. I'm kind of curious, I think you're really good at reading between the lines on companies and how they communicate certain things. Like they could put out a new disclosure or change the disclosure or change the way that they describe something. And I think you're good at, instead of just reading it and thinking nothing of it, you're good at interpreting what that could mean. Do you think a lot of the situations that end up to be big blowups or just, frauds or big, mistakes for investors, do you think a lot of times the companies sort of kind of communicate it where it's out there in the open, as opposed to just waking up one day and be like, oh, wow, this is going to be bad. This headline just came out and this is going to be an issue. And I always think of a time actually when I was reading through a quarterly report and they added some new disclosure about, I don't know if it was internal controls, but they had mentioned that a company they used to be affiliated with was being investigated by the IRS for tax issues.
Oh.
And they just added that disclosure in there randomly one quarter. And I was like, okay, I know for a fact I haven't read this disclosure before. And I use a website called Draftable where you could put in this, a present quarterly report or 10K or document, and then you could put in an older one and it compares. It's basically like what lawyers use, or when you strike out stuff, it just tells the difference between the two. And I was like, yeah, they've never entered this this disclosure, or they've never said this in any of their filings before. And I felt like that was signal, that they're telling you something could happen. I don't know if they add in their risk section or what. I can't remember right now, but it seems like how success leaves clues, the other side, failure, leaves clues as well. Would you agree with that?
Yeah. So I think some of the issues you can identify, one thing is with any sort of thing with fraud things or anything like that, you're not going to have, it's very hard to have direct evidence of it because it's the intent, which is a coordinated intent to do something. So there's always an explanation for it. It's the opposite of a murder thing. with a murder, with a homicide, someone's dead. We figure out they've been killed probably by someone else, and then we figure out who did it and everything. But there's not this argument about whether there was this crime committed and what the intent was to do that. It's really about who did it and all of that. This is almost always the reverse, which is that there can be agreement on what the act was, but there's disagreement on what the intent was behind it. And so it's only when put into perspective with a bunch of other things that you can really figure out what is going on. And so the defense against it, always from people who like the stock or from whatever people who deny it and stuff, is that, yes, there's 5, 6, 7, 8 different isolated things that you found that are a little unusual, irregularities. But it's hard to actually, you haven't actually been able to put together how they fit together and prove what was going on there, right? So that's always the difficulty about it, and I think that's one of the hardest things. So what that means is that each thing that you discover kind of seems slightly innocent. You're never going to find that one thing that that you'll be able to convince people of is clearly wrong that someone did. The most common thing that I think you find, or I find, is that I can't understand it. And I've said this before a lot to people, but genuinely that I cannot understand what they're saying, what they're doing. Being unclear is really the big hint. Because that's sort of the thing you have to do, is you can't say why you're doing it, the real reason that you're doing it. So it ends up very obscure. Now, the defense of many businesses will be, well, it really is very confusing and stuff, and it's very hard to understand and everything. It's very technical, and this is why you don't understand it. And but that's always sort of the signal. So I think I mentioned that in a 10K that I read one time, that it made a comment of something that was an accounting thing. It used a term that I'd never seen before. I've read a lot of 10Ks, so if they describe an asset in a way that I've never seen that used, so like you always read deferred tax asset. Okay, so it could be complicated or not what that means, but it appears a lot and you can understand what it means, and then you just have to find context of it. So this was just a term I'd never seen before. And then when looking to find the explanation of it, because if it's a term I've never seen before, really, there should be a description of it, an explanation of what it is there. I didn't find it. And that seems like a really small thing, but that's so highly unusual that it almost means that they're definitely doing something very strange. Because there shouldn't be a description of an item that I haven't seen before used with those terms. Why would one business have it and hundreds of others never have used this term before? And then if you use something that's so unusual, and that's fine. Buffett said owner earnings. Well, that's not a term other people use and stuff. But then he goes on and he talks about it and he describes it and explains what are owner earnings. You can make up anything that you want. You just have to describe it somewhere. So, so you need to kind of give me a gloss of it, so that's the biggest issue that I find. And there are some things that I've read that people have sent me that I find completely confounding. And, they hurt your brain. And in some cases,
like what's an example? Yeah.
Well, I can't give
your head.
No, I can't give an example because one of them, there was a short report on it. It fell a lot, and there's clearly some fraud involved. But
was it a roll-up?
Actually, sort of. It's more complicated than that. So, yes, it was a roll-up, but they were creating the things they were rolling up. So they're creating things outside the company. Then they were rolling them into the company, but there's strong evidence, I think, that they were the ones who really created it through other related parties and things, the thing, and they absorbed it. Yeah, okay.
Is this the company that came crashing down as of like the past year?
Yeah, no, it's still a publicly traded company and stuff. It has some substance to it. But anyway, it was doing something. My point is, it was doing something with it was doing something in a particular way that I think the only purpose of that, to me to understand it, is basically you wanted to have stuff you weren't going to report. So like, to simplify the idea, you wanted to like lose some money and stuff and not report you were losing money for. It's sort of like you wanted to start up some businesses, have some losses, not report them, and then once the company was making some money, make it part of your company. All right, that's kind of a gross simplification of it, but that's the sort of thing they were probably wanting to do. There's no legitimate reason for why you can't accidentally we now understand we made a mistake. We're very sorry that this doesn't conform to accounting rules. I mean, you were doing that for a reason. And as they were with lots of different companies with like wanting to report things in a certain way, right? That you have an idea that people will focus on this number or whatever. So that's the other really big one is, when people are focused on a particular number, not focused on lots of other numbers. The .com thing was bad that way because there was more focus on numbers which weren't GAAP numbers, right? Mm-hmm. And so that gets tricky because when we start talking about things like what's an active user, right? Now we can make up, there's a lot more disagreement about what is a daily active user, monthly active user.
You're seeing that now with Twitter and Elon going in there. He tried backing out of his deal because of that. I'm sure there's other things as well, but that's what he was using an example as.
Right. And so there's a lot more disagreement on that. That doesn't mean that they're bad measures to use. It's fine. And actually, I think they'd be really good measures to use if less people focused on them. What always worries me is when there's something that people focus on a lot. I know we've talked about this before, but, like people ask, like, should you focus on, or here's what they say basically is like, what's the hardest thing to fake? Like, isn't it really hard to fake free cash flow or something? Not exactly. What's hard to fake, what's very, very hard to fake is a variety of different things looking legitimate together and letting you choose what to look at in relation to each other. But any one number is not that hard to fake. Some companies are valued on sales. Sales are like the easiest thing in the world to fake. Sales are actually a very squishy number from an accounting perspective, but they're not that easy to fake in relation to other things because then it would throw off all sorts of others. Then you'd have to explain, why did your gross margins drop to nothing? Mm-hmm. But if people don't care about that at all, if they really only are valuing it on 10 times sales and who cares what the gross margins are and it's okay, then you can fool them. But as long as they're paying attention to the different items, like when we go through Quick FS and we look at each of these things, then it's hard because anything you do is going to affect these other items in a way that looks very strange. And so that's like when we talk about, valued on sales, valued on gross profit, value on, you never want to just value it on one thing. It's okay in cases where the accounting is very similar between the companies and very legitimate, but there were cases, at the, like this was a private company at the time, but in the later stages of like WeWork, where I think it was just purely done to manufacture evaluation. It was literally
he knew that.
Yeah, so it's okay. They only care about my sales, right? Like they're only valuing on revenue and stuff. So here's how much square feet I get. Here's how many people I put. Here's how much I can put in here and stuff. And to manufacture sales, and it doesn't matter at what cost I manufacture those sales. So it's not like a real business that way, So I don't have a problem with any of these, where like Munger complains about EBITDA or something. I don't have a problem with any of these measures being used, and sometimes these measures are better, free cash flow or whatever. But they're actually best when management doesn't talk about them. So the thing that should give you the greatest confidence is this company producing like terrific free cash flow and stuff, and they only talk to you about reported earnings. Because then they're not managing that number the way they report it to you, and there's nothing that they're doing with it to target that number. And so actually a number that's just achieved as a result of aiming for other things, and it naturally comes along, is a big help. Once you start actually focusing in on a specific number, measuring that number, making everything guided towards that number, then it becomes less reliable. And in some companies, there's a really good, it's hard to fake things and stuff because they're very tangible business, and it would be very obvious what you're doing. So, we can't fake a ton of stuff with Chipotle because we can go in there, we can look at these things, and we start to figure out, well, that doesn't make any sense. How can you be, you can go to one and be like, well, you can't be having 5,000 people a day going through it if I'm sitting there and seeing that.
$10 million per unit.
Yeah. But, we're, back to the .com era and stuff with Enron, the stuff that Enron was booking and things is just like totally on, it's trading stuff that they're doing. Investment bank, it can report whatever it wants. People don't understand what it's doing.
But you would see that in the accounting, right? From like net income to cash flow.
Well, yeah, but some things are really, like someone was asking me about Credit Suisse, and so they had me read all their stuff for it and stuff. And so many different units doing so many different things that there's nothing wrong with it. Like, I'm not saying that they're doing anything wrong. I'm saying it's complicated, and if you misunderstood which part they were putting something in, it could get confusing. Like, for instance, they moved some stuff from like how they segment it from like wealth management to investment bank, or investment bank to wealth management and stuff. That can get very tricky with what that means. And so like, it's very easy for you not to understand what's happening. Reclassifying things constantly and stuff can really fool you. With conglomerates, it's, simple businesses like we're talking about, like a Chipotle thing, is easy. But if you suddenly are Chipotle, but you also take that and mix that with Netflix, and take that and mix that with a life insurer, and you say, well, each of them are a pretty simple business, but once you blend those accounting together, it's now now there's room for tricking people about stuff, because you're booking things, unless you segment it out properly, you're booking things in different ways to really fool them. You're making a financial transaction and it looks like a burrito sale because of how you're able to do that if you have those things mixed in together. And you have to, and like Berkshire Hathaway, they break out some different things. It's those kinds of things with conglomerates is a very easy way to trick people, because they just focus on like, revenue or whatever. And it's mixing in things of a financial nature with things of a very real nature. And it's very possible to be too confusing for them. That was a lot of GE. It's just like, it was, a lot of that was, but analysts understood, I think, and they kind of winked at it and stuff. But it's like, we will talk a lot about some very basic businesses, and we lump everything together, and we get more and more earnings from stuff that aren't that, but we still present ourselves as if that is what this might be coming from, So you moved it because it's a lot of financialization. You took something that looked like an industrial company or something, and over time you made it very financial, and you kind of didn't were trying to get valued as if you were still more of a predictable financial thing, instead a predictable industrial thing, instead of being something that is more value based on a purely financial basis. So I think that draws people in sometimes because of the past record, with a company like that. That is what happened. I don't think no matter what we say, I don't think it's possible to dissuade people from chasing after some of these things. So I think it's pretty hopeless, to be honest, having the experience of doing this for a while. People want to believe in stuff, sometimes really good stuff, sometimes really bad stuff, and they'll believe in it even when it doesn't make a lot of sense. It doesn't hold together really coherently that well. it's one of the things I found difficult for people to avoid. And it's one of the reasons why I think, some degree of diversification and stuff beyond what I think is really warranted statistically, I'm kind of okay with, because I do realize the adverse selection kind of stuff might be more than I realized with some investors, that they have a tendency to end up holding stuff more in their portfolio that's kind of being sold to them more than just going out and picking stuff themselves. It turns out that when you look at their portfolio, it's more stuff that was promoted to them than just stuff they found on their own. It's not an actual sample that it doesn't have to do with how it was sold to them by investor relations and stuff, but actually has a higher proportion of things that have been kind of promoted a bit. I do realize that when people talk to me. Yeah.
I mean, you'd be even surprised, Geoff, the amount of prospective investors, in air quotes, I speak to, that just call to try getting our best ideas. And I know they're running their own book, and I think they make, a business out of, or I guess they use all their investing time just reaching out to funds as prospective investors. And then it's, what's your best current idea? And I'm like, get out of here. Get out of here.
Yeah.
Like,
yeah.
What?
And it can, that can kind of work to some extent. I mean, if you pick the right people. So like Phil Fisher talked about this, where he was surprised that when he actually like studied where he got his ideas and stuff, it came much more so from other investors that he really respected and stuff. And that is true. If you find the right people, that it does kind of sort itself. It is a much better kind of screen than running a screen, it is, well, at least get your ideas from us instead of getting it from investor relations or something.
Yeah.
Well,
you've talked about that before, right? Sometimes people will bring an idea to you, and all of the positives that they talk about it are the positives that the management team outlines in their investor presentation.
Yeah, that's a big issue. And I do notice that. I don't talk to a lot of people where there's really unique things about the value they find in the company that isn't talked about by the management and the investor relations and stuff. It really shapes what things you talk about. And I think maybe that's more the thing to think about is like, it's not like, oh, they're faking these numbers and this and that and stuff. That's not how most things work with most companies. That's such a small portion of the things you have to be afraid of. It's that they are directing you to what to pay attention to, right? So there's good, when we look at anything, that's what I mean by spin and stuff. When we look at anything, there's good and bad to it. When we do the quick FS stuff, we should be saying, okay, here's the things that are positive, here's the things that are negative. You can direct people's attention to just the positive things, right, and away from the negative. So let's say you're some company that has a lot of assets and you're undervalued relative to those assets and stuff, but your core business is not very good. You're not really generating stuff. You can make your presentation all about how you're undervalued versus your assets and try to avoid talking about the fact you're not really producing much in the way of earnings, or the other way around. We produce all these great earnings and stuff, but there's not much of substance here and whatever. We can just talk about that. And people will not really notice that they've been directed completely to focusing on one thing and not another. And maybe you overcome that with checklists or something like that. You don't really, I don't know how really. The unfortunate thing is that it seems completely who is doing the analyzing. So there's some people who everything that they would bring to me could fall in this category. There are others who will never bring something that's a bunch of fluff that's been brought to them by management. They never buy into any of that stuff. And you would know that right away from what they've brought in the past and how they talk about things. It's just a personality thing.
What is that personality?
Some people are like investigative reporter personality types, and some people are a different personality type. I don't know exactly how to describe it. Just as some people are really excited. I mean, some people are just really excited about upside. Mm-hmm. And I mean, I did a newsletter where I did net nets. It was one of the worst experiences writing about things, talking about things, whatever, of my time in investing, because net nets are a good thing to invest in. As a category, they outperform almost any other thing. I mean, any of this quant stuff, which is meant to be applied to much more liquid and large stocks and stuff, so that's why this doesn't work, but it is not even close to net nets. I mean, this silly little strategy of buying net nets outperforms all this stuff that people spend tons of money in huge organizations to develop these quant stuff. It can't match net nets. And not only that, it's pretty easy to improve upon the core returns of the net thing and to shift it in a really meaningful way, not just improve in like I don't mean on a basis of like the annualized return you'll get with a pool of them, just that your mean return will be higher or whatever, but actually shifting it so that you have very few losses and whatever. But most people, and there's small little exception to this, but most people, like if you write something about a website for NetNets or a newsletter for NetNets or just talk to people on this podcast about NetNets, they are remarkably good at picking the wrong ones. And some of them might work out, but like they're amazingly good at picking, one, the frauds, but two, the ones that are financially in serious distress that they could go out of business and stuff, as opposed to things that have very little chance of going out of business and have zero chance of being frauds, when sometimes people have asked me about that, about like the stock, like, why are you so confident? Or not why are you so confident this isn't a fraud, but like, how would I know? Like, they'll look at a stock and they'll say, I really don't know how to evaluate if this is a fraud or not fraud. And I'll say, they've, in the last 20 years, management hasn't sold a share of stock. In the last 20 years, they haven't issued stock to anyone. They've paid dividends all the time, and other things like that. But they don't have things listed as borrowing it, and yet they do have things listed as cash and stuff. Whereas there'll be some other situation where they'll have both a lot of borrowings and a lot of cash. They'll be issuing a lot of stock. They'll be selling a lot of stock, whatever. They'll never pay dividend. Those factors together, you say, this doesn't really make sense. What kind of fraud would this be, And they never try to draw anyone's attention to it. And if you, say like, can I talk to investor relations or whatever, they're saying, well, we don't really talk about that, or they don't answer your email or whatever. Probably not a fraud. And so, yeah, my experience with the net thing was awful that way, because the selection that people would make would be really bad. If you gave them a list of net nets, they would pick they would disproportionately pick those that would likely, as a group, to give them a worse return, and certainly to have almost would always be the ones that would have the very bad outcomes in them. You might get lucky with a few home runs in it too. So their overall record might not be terrible if they held them both, but they certainly would pick all the bad outcomes. When we talk about like the tails of a distribution, these would be the ones that'd be really bad. They'd always get those in the mix, and way more than you should in just sampling something. And I don't think I always understood why they would do that, but I think it's mainly because of like the upside thing that they were looking for. I would stress, it's not important what the upside is in a net. A net is very cheap, so they all have upside. If they survive and they're halfway decent, they have upside. But just like the possibility of that, also, they'd want growing things and stuff like that. So, I don't think a fast growing net is necessarily a great idea. Why would it be a net if it was growing fast and everything like that? But yeah. And so, so that thing about picking the wrong net nets, I see that same sort of pattern in attitudes about things that might be frauds, or might just be taking an incredible amount of like financial risk, and not being that honest about it. I mean, I say frauds or things that are likely to like blow up or something because of what management is doing, and that management is not being very honest with you. Not being honest with you is not exactly fraud, but you can certainly figure out lots of cases where they're not very candid. And so people may have a much higher potential for picking frauds than I realize. I think over time I've come to see that that's true. That I would not think that's something you have to really avoid a lot, and not something to pay a lot of attention to because it's such a small part of the market. But people do get kind of caught up in hype things more than I would realize. So, that is maybe the best way to fight that is like the 10K a day thing we're talked about. Just constantly finding things yourself and reading about them. I guess the thing I probably didn't realize enough when writing that thing or just talking to people is that people are pretty passively finding things, maybe more so than I realized. Their investment process is more ideas are fed to them more than they might realize. And so it's not a very clean sample that they're getting. What they're getting is things that people are hyping, people are talking about, even if it's not just, initially it's management talking about it, but then it spreads onto groups and message boards and other people and Twitter and whatever things of people that they know. And, but the initial reason why it started coming out there was management.
How much of the investment industry is like that though, right? Like think about these hedge funds that have a group of analysts and then they have their idea meetings and all they're doing is being fed, stocks and research that's not even theirs and having to make investment decisions based on their analysts' recommendations.
Yeah, that's true. And there's not really anything wrong with that if you have the ability to judge other people's ideas well. So like professionals doing that, it depends on who they are, but some of them, I think that's not a terrible way of doing it if they have the right personality and the right experience to understand that, of what they're doing. Yeah, but that is more. It's always better if you go and find the things. I mean, it's always safer if you go and find the things yourself without having it pushed on you. But that's just like a general thing about investing in focus on spinoffs, don't focus on IPOs, focus on things that everyone wants. Those are just general rules that will always be true and you should always pay attention to. Why not buy the SPACs? I mean, why would you ever buy the SPACs? I mean, everything about it, right, is like, it's just the kind of thing you don't want to buy, or kind of thing you don't want to go about your way of buying something. It's not that it couldn't work out, but it's like if you bought your car because someone sent you something in the mail to you that said, here's this car I want to sell you and it's a great price that I have on it and stuff, and you said okay and you bought that, it might work out fine, but that's not such a good way to perform the search, is to respond to direct mailing to you, right? There's something about that suggests to be wary that that's not going to be a clean sample of what's in the market and stuff, but that actually you're getting something pushed on you, right? That like they're targeting you to sell you something. The SPACs were targeting people to sell them something with the whole way, the structure of how it's created and everything. And like, it's a way of making it, it's a way of creating conditions to sell to people that way. I mean, the IPO thing, it's less so now than it was when we were talking about 20 years ago, but the whole like scarcity thing of it, that you were getting doled out this scarce resource when they would decide who would have it before, and it was going to have the one day pop, of course, and all of that. That's all that the idea to have that one day gain and to be on the inside of getting that it was a scarce thing to get in on, is like a whole way of, promoting something. It's it's playing on people's psychological things about how to do that. And there's no need for that's how you get stock into the market, but it's like a system that was effective that way for people, because it plays to what kind of thinking they have about it. And SPACs had that too, because it created there's a whole thing about what it did, but some of the things about what it was creating was a sense of there's a lottery ticket sense to it, because there's an aspect of you don't know what they're going to do with it and stuff. And then there's also a they're playing to two things which are very powerful with people, which is that you think it's no way to lose kind of thing. That's one of the easiest ways to get people, is to create a risk-free seeming sort of thing. And also the lottery ticket sort of thing. If you're going to do a stock write-up, right, you always want to say that there's a lottery ticket attached to it, right? If I'm going to do it, I want to get in Value Investors Club or whatever thing, or whatever, just like people like my post about something. Whatever stock it is, we should present it as, here's the core thing, and then there's this lottery ticket attached to it. That always works for people. And the other thing is like that there's some floor that I can't lose money. I mean, that's the other thing when you do a write-up of something, is like, well, there's no way this can go under $9, because I've calculated how this floor is, that the sum of the parts isn't less than this or whatever, Yeah. So there's certain ways to play to people's psychology that way. And the thing with online and all of this stuff is that, like for us value investors and stuff, some of these CEOs and stuff and investor relations and everything, they can read everything that we're doing. They can be online and on Twitter and whatever. They can see what words we use and what ways we think and stuff. And so they can tailor their message more towards us than used to be the case. Like there was just, 20 years ago when I got into investing, there was really just one, it was broadcasting. It was, if you had a message about your company, everyone got that same message, It was not like I'm focused in on the people who are looking for this thing or that thing. There was no communities of people that were really, so you couldn't present yourself as like a compounder thing, in one way and then something else. You had to, it was much more generic because there weren't these communities and the social media and these sorts of things. So now you can definitely tailor it more. That's not just an investing thing. It's like an everything thing that you can narrowcast,
Got it. Cool. Well, I want to thank everybody so much for tuning in with the both of us. We are over 2 hours on today's podcast. We kind of switched it up. Normally we do a topic and then stocks, but this podcast we did stocks and got a topic out of it. So all is well. If this is the first time you are tuning in with us, be sure to hit that subscribe button wherever you're listening or watching. Leave us a rating review. Those still go a very long way for us. It helps spread the word. We did use QuickFS on today's podcast, and we use it every single day. So if you want to sign up for that, go to quickfs.net. One thing we didn't do was actually download the financials. If you click this button right here, you could download 20-year financials in an Excel format. It's one of my favorite features about QuickFS, and you have to be a member to get 20-year financials for that. So go to quickfs.net, and when you do sign up, because you certainly will, tell them that you heard about them from Focus Compounding. If you're interested in learning about our money management services, go to focuscompounding.com, hit that Invest With Us tab right here, and you'll get everything you want to know about that. You could reach out to me at andrew@focuscompounding.com to start that conversation. I thank everybody so much for tuning in with the both of us. We are the #1 value investing podcast in the world, undisputed. We really appreciate you spending time with us, and we will see you next week in our next podcast. Take care.